Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Now, anything can happen at any point in time. And you'll see a lot of activity. Those are the trades that I'm proud of. Hello and welcome to the Stock Play of the Day. My name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. All right, well, a lot going on in the markets. I hope you had a great holiday. I did. I'm still trying to get over all the turkey that was consumed over the last week. But with that said, let's start by just looking at the markets. Let's do a quick little overview. We've been talking a lot about the retail customer. And in our quarterly outlook that was written by Lindsay Bell before she went on maternity leave. And in that quarterly outlook, talked about, I actually even made a joke in a few of my weekly viewpoints about it's a bird, it's a plane, it's the retail consumer. Bottom line is that was the one bright spot that was in the marketplace. And we did see that come through over the holidays. We still saw an increase in spending. There were still basically some good news in that area, a little bit mixed, which you would expect, but the consumer appears to be strong. One of the things that has made the consumer strong is that we've had strong wage growth, especially on the lower end of the tier and the hourly workers. So because of this, a lot of people are saying that they are going to be less on a spending spree this holiday season, but they're actually putting their money where their mouth is. Johnny is still going to get his Christmas present, if you will. And because of that, it's kind of propped up the markets, but the markets are very schizophrenic at this moment. We're up one day, we're down one day. Now we have new geopolitical concerns with what's going on in China. A lot of riots, not a lot of news coming out of there, but a lot of videos are coming out, and that's creating some havoc in the marketplace. The Fed is still actually leaning more hawkish. Since we've seen the retail data, what has happened in the Fed Watch tool, which is put out by the CME, that tracks the possibility of a Fed rate hike. Everybody was anticipating in the next 15 days that they were going to hike around 50 basis points. Now, all of a sudden, we got a bump up over this last week, looking more like possibly a 75 basis point hike. Now, that's in general would be scary for the market because that would be a little bit of a shock. Obviously, right now, the concern is that the Fed is being too strong, too hawkish. Everybody on the pundit side of things is kind of hoping that it still stays at that 50 basis point. But the strong retail consumer and the decent numbers over Black Friday and Cyber Monday have kind of spooked the markets a little bit. So we have a jobs report coming out this week. We have some comments coming out this week. So it's going to be, as usual, in this time, a very news-oriented marketplace. And I think the markets are showing that. We're seeing, one day we had, just this week alone, we had energy stocks down 1 or 2%. Now today they're back up 1 or 2%. And I think we're going to see a lot more of that going into year end. It'd be really nice if we could get above the 4,000 level. Actually talked about that level a couple of months ago. if we got a strong retail season. Now, the Fed it's another one of those good news, bad news things. The Fed might take this news as bad news overall. They don't necessarily care if the market's going up or down, but they see that the retail customer is still spending. And in general, that is bad for what the Fed's goal is on lowering inflation. So that's where we're at. So let's look at the markets. Guess what? We're down 14 points in the S&P 500 index. The VIX is down around 22%, showing a little bit more in the fear index world is actually fairly flat at 22%. I'd say normal volatility ever since the pandemic is down around 20%. You might even call that low volatility. That 20% number really seems to be a line in the sand that was established during the pandemic. It took forever for us to actually break below that on the VIX, and we're trading right around 22% right now. I guess the next, as far as the U.S. is concerned, the next major thing is able to kick the can down the road, if you will, on a budget plan that could possibly, if they don't come, I think it's by December 15th, if they don't come up with a bill to increase the budget. Once again, we're going to have that same battle year in and year out. The government could potentially partially shut down. So that's one of the concerns that the VIX will be looking at. But right now, it's not a major concern. All right. So everything kind of leans a little bit on the 10-year and the interest rates. Everybody's paying a lot of attention on this, and I'm highlighting it inside the notes. So the interest rate right now on the 10-year has came off a little bit, and also we still have the skew between the front month and the back month, or I'm sorry, from the near-term Treasury rate versus the longer-term rates, and that still just shows signs of recession. So there's still a lot of questions out there, but we're really hoping that with everything that's going on, that it might be considered a soft landing, which would be good for the markets. I think the biggest headwind is if we see the Fed actually go from 50 basis points. And right now it's saying over a 30% chance, if you look at the Fed Watch tool put out by the CME, over a 30% chance, which was about a 25% chance before the retail sales numbers came out from Black Friday and Cyber Monday. All right. So before we left for the vacation, for the holidays, we looked at SMH trade. We looked at a trade in the semiconductors. Now, that trade has kind of gotten beaten up, probably a lot to do with what's going on in China, but demand is still there for chips. We kind of mentioned that it's volatile. We see the implied volatility in the ETF that we were trading, which is the SMH, was real. And we're seeing it to the downside. So there's an opportunity here in that the trade did not work out. I did go out further in time to give it more chance for the underlying to run, which I mentioned in last week's show that it is a buffer. And if you're when you're looking at a long call spread, which was the trade that we did, and I'm going to highlight that here. Let me pull up the long call spread inside the options playbook, the book that I authored. If we look at this, we see that what you really want on a long call spread is you're buying one option contract and selling an option contract. The one that you sold wants the market to stay flat or go down. The one that you bought wants the market to go up, period. And so strike B here is always fighting strike A. And the best way to max out on a long call spread is to have as little time premium in the option contract that you sold if you're correct on your forecast. Now, when does that happen? Well, time premium goes away when implied volatility goes down, I guess would be a better way to say it. And if you get some time decay in that option contract. Well, we went out further in time because we were a little bit nervous. We did an out-of-the-money contract a little bit. A lot of these are FOMO trades because the market's just so tough to be picking stocks in right now. Obviously, I would say we're still in a bear market relative. Path of least resistance right now seems to be that way, even though we've had a good month so far in November, and hopefully we get a Santa Claus rally at the end of December. Okay, so I digress. So this is, if we were correct on our forecast, all that time premium in strike B by going out till December 16th, which is our expiration, would have hurt us. But guess what? We weren't correct on our forecast, and now it's hurting us. So it gives us an opportunity to talk about adjustments. So sometimes, and as we say always here on Stock Play of the Day, is that nothing's meant to be a recommendation. We're just doing it on paper. If you always are correct on your forecast, well, then it's hard to discuss what happens when the market goes against you. So this is an opportunity that we have this week to talk about an alternative. And I would have adjusted this trade prior to this, but the trade actually isn't doing that bad considering what has happened in SMH since we talked about it a couple of weeks back on the last Stock Play of the Day. All right, so let me run to a chart in the SMH. 1 second here. 1 second. I'm not quite sure why that chart's not there. All right, good. It came up. Here we go. All right, let's look at it. Okay, so in the SMH, I'm just looking at a 1 month chart, and this is the day that we looked at doing the SMH trade. Now, a couple of things were happening on that day, and I want to highlight them. And I mentioned this as far as moving averages are concerned, we saw that bumped up right against the 200-day moving average. That provided resistance to the upside. But we also had a good news situation in that we saw the 20-day moving average cross over the 50-day moving average. Now, we call that a golden cross. I think there's a lot more weight when you're dealing with the 200-day moving average. In other words, when you see a 50-day moving average cross over the 200-day to the upside, that would be positive. To the downside would be negative. Now, I don't always put a lot of weight in that, but it is, it is a charting factor. We saw right up at the 200-day moving average. Hopefully, we were going to try to break out of that. We had the golden cross down here between the 20-day and the 50-day moving average. And I'll highlight the green is 20. You can see that by putting my cursor there. And the red is 50. And here's like an example of a death cross where we had the 20-day go over the 50-day, and that started a slow bearish trend in the underlying stock. So we were hoping that maybe we would get that bullish trend. So the chart didn't look horrible. And we haven't had a too rough of a move relative with a high volatile environment like in the semiconductors, but we are now down. We were up here at 227, I think. My notes, 227.69 is what the trade was at when we looked at doing it. Now we're down at 215. So obviously that's a solid move to the downside since we left for the holidays. What can we do about that trade? Okay, so we started with a long call spread. So I'm going to run to the playbook real quick. We're going to actually look at adjusting the trade. Now, you could just get out of the trade. We put the trade on for $4.90. I'm going to show you this in just a second, but live markets are saying that it's trading around $2 at the midpoint. So you'd be down about $2.90. I've talked about if you pay $4.90, if you were down about half of that, maybe you'd think about getting out somewhere around $2.40, $2.50. We're now down to $2, and I would have made the adjustment down around the $2.50 mark if I were to adjust. If the spread was trading for about $2.50, that's when I would have thought about making the adjustment. So now you could just sell your trade and get out. That's simple. Sell to close the long leg, buy to close the short leg, and say, okay, I wasn't right about the market, and so now I'm just going to take my comeuppance and I'm going to look for another trade. Nothing wrong with that. An alternative here is to roll this from this long call spread into a long call butterfly. Now, I might wait a little bit before I do that, but what that curtails would be selling one more of the option contract at strike B. So I'm going to run back and just flip back and forth real quick. Remember, we're short one option contract there at strike B. Now I'm going to run back to the other one. Here we go. And then we are going to add another one still at strike B and then buy an alternative, effectively selling a short spread and rolling this position into a long butterfly. Now, it's an alternative It's not going to bring in as much cash as if we just closed out the position, but it'll give us a chip in a chair, if you will. We will sell, lower our overall risk, bringing in a net credit to the account, and then hope that the stock still keeps going towards strike B. And that would be our best case scenario, that it landed somewhere between strike A and strike C, hopefully closer to strike B. Okay, time decay is going to get big because we're December 16th is our expiration date. So this would be a time that you would consider it. Maybe I'd wait for a little bit of a bounce up, but this would be the trade. So let me walk you through on the Ally Invest option chains, how this would look. Okay. So here we are. Right now, we look at SMH, $215.31. The expiration is 17 days away. On the left-hand side, we have the calls. On the right-hand side, we have the put. I already have the trade set up, the initial trade from, I guess it's a couple of weeks ago now. 225 is the one that we bought. 235 is what we sold. Paid a net debit of $4.90 for every 1-by-1 spread, limiting our risk to $490 plus commission on that trade. We now see it trading for $2.16, so the market has ran up a little bit. So it's now $2.16 if we were to sell it to close the position. Here's what the adjustment would be. We're going to sell one more of the 235s, and we would buy one of the 245s. Now, in order to do this and show you that I'm just adding a credit spread, I'm going to remove this strike, okay? Because the adjustment to the trade would mean that we're selling another of the 235s and we're buying one of the 245s, bringing in a net credit of 80 cents. Now, if we would have did this a little bit ago, like let's say last week or something, and the market was up a little bit higher, a little bit less time decay, honestly, probably last Tuesday, if we would have had a show, we would have looked at this adjustment. But with that said, you're bringing in 80 cents. You paid $4.90 for this trade. You could sell it, get out for around $2.10, it's looking like. If you did that, you'd be out. Now I'm going to bring in 80 cents and lower my risk by that 80 cents, but I still got a chance that I could still make that $10 on that trade, right? Because I'm still in the position. So I'm reducing my risk. I got a little bit different risk reward profile at the end here, a little bit different, but I'm still in the trade. I'm not out. So this would be the adjustment, and this is what you would end up with. I'm selling that, bringing a net credit of 80 cents, reduce my risk by 80 cents. Now I'm going to go back and add the 225 strike, and we're going to look at the profit and loss graph then. Okay, 1 by 2 by 1. And if we scroll down here and we zoom in, okay, so this is where the market is at. And what we did was add this short spread in. So if the market comes roaring back, that's a bad thing. All the way up to 245, we still got the same amount of risk, but it's a little less risk. We would lose, we started at 490, bring in 80 cents if we could fill at the midpoint. We would have $4.10 worth of risk, and that's where that would be at. But we would want it to land somewhere in the middle here, and then that would help us out. That would help us out on the overall trade if we thought that we could get a bounce back in the marketplace. Now, there's nothing on the chart or anything that really says that could happen. We still have a lot of concerns going on in the market. I'm, once again, not recommending that this would be the adjustment to the paper trade. I just wanted to show you that it's there. What might I do in this scenario is maybe I would wait it out a little bit, see if we are going to get a little bit of a dead cat bounce in SMH, in the semis. And if I got the stock to go up 4 or 5 points, then I would consider doing this trade. Be a little bit closer to the expiration date, but you have the risk that it could go the other way. So this is the adjustment. Let's just put it that way. It's straightforward. Either sell it, close out the position. I wouldn't want to wait around anymore. If I was in the long call spread, I would either make this adjustment or I would sell and close the entire spread. And that is the way that I would look at this. Okay. Now, we're going to talk about Boeing today. And once again, it's going to be a little bit more of a, where are the bright spots in the marketplace? Boeing has made a fairly strong move recently. Kind of considered one of the defense stocks. The government obviously wants Boeing to do well, just because the government, in this type of geopolitical and this type of environment, just in general, any stock that is a defensive stock has done fairly decent. And so Boeing has had rough times ever since their debacle with the MAX and everything to go with that. Hasn't seen new highs in many, many years, but it's up a little bit recently. So we're going to look at buying a deeper in the money call option as an alternative to owning the stock outright. So you could just jump in and buy 100 shares of stock, but as an alternative to buying that 100 shares of stock, we're going to buy a deeper in the money option contract and have limited and known risk on the downside. It still will be a fairly expensive option contract, but we're trying to duplicate the stock, using it as a stock surrogate. So we're going to go deeper in the money, and hence you're going to get, if the stock goes up one, your option contract should give you most of that movement on the upside. And that's what our goal is by going deeper in the money. If you have any questions about that alternative trade that I just looked at, please put them in the chat box. We want to make this an open conversation. I'm going to try to address them at the very end of the show, so it's good that you get them in there right now, and then I can go back and look at them and we can try to address them. So if you have a question top of mind, please put it in the chat box right now, and I will address them at the end of the show. Okay, here we go. Let's go back and look at the options playbook real quick. This is a section in the Rookies Corner, buying a LEAPS call as a stock substitute. Now, LEAPS is just an acronym for longer term options. It means long-term equity anticipation securities. Just a marketing term that the CBOE came up with. Just means usually option contracts that are over 9 months out in time. We're going to be looking at something not quite that far out. We're just going to go out a couple, maybe 150 days. I still got to go to the chain and check exactly how far out we want to go. So let me run over to the chain real quick. Let me find that and see where we're at with that underlying. Okay, struggling a little bit with getting the option chain to come up. 1 second here. All right, there we go. Let me pull up that chain now. Okay, come on. I think I might have gotten logged out of this chain right now. All right, give me 2 seconds here. I'm still gonna get the trade up and running, but it looks like for some reason I was logged out of my account at this moment. So I'm gonna have to just basically log back in. And I see a few of the questions that are in the chat box, and I appreciate the questions that we have. One of them, let me see if I can answer one while I'm trying to log back in. Which is better, buying or selling options? That's a good question, and there's a lot of argument. I don't think there's any better or worse. You can make the argument if you're going to say that, in that, okay, going into September and October, we had implied volatilities down around 20%. I think in the beginning of August, we saw the VIX index trading right around 20%. So you got to make the argument then, the VIX index by the end of September and October was trading up around 30 to 35% implied volatility. So if you look at that and you're asking that question specifically, I'm going to give you kind of a highfalutin answer, but if you think implied volatility is going to go up, you want to be the buyer of those option contracts. You want to be the buyer of SPX calls or puts, depending on your direction. You still got to get the direction right, but implied volatility is going up is going to help you if you are a call buyer. Implied volatility is going down is going to help you if you are a call seller. So there's no golden book of answers as to what is the best strategy. And that's what the stock play of the day is all about, is that we are inside the stock play of the day, we are just trying to take some of the strategies and apply them to market conditions. So to answer that question, which isn't punting it, is to say that it depends on what the underlying is and where implied volatilities are at. If you do think implied volatilities are going to come down, well, I'm going to adjust my strategy accordingly. Part of the reason why in the SMH that we just looked at, that trade, we did an out of the money long call spread. SMH is volatile, the marketplace is volatile. We were a little bit more concerned about what could happen, which did happen. The market went down. So instead of buying an option outright, we went out and bought one and sold one to try to offset some of that risk of time decay and implied volatility. If it was a stock where I was a little bit more confident in, I would have just bought the option contract, especially if implied volatilities were at decent levels, but they weren't. It was that simple. So what's better, buying or selling? It always depends. You got to look at market conditions and then look at the playbook and decide what strategy might apply. And that's what the stock play of the day is all about. So thank you so much for the question. And it also allowed me to get logged back in here. A few more seconds, and I'm hoping that I'll be able to look at a Boeing chain inside the Ally Invest option chains. And we're going a little bit long here, mainly because of that scenario. All right, chains are up and running. Here's Boeing. Let me get an expiration that's far enough out. We'll go out to next year. We'll go out to February, 80 days away. We're going to go a little bit in the money on this option contract. And the strategy inside, if you want to pull up the Options Playbook website, is in the Rookies Corner, buying leaps as a stock substitute. We're not going to use an actual leap, but we're going to come close here. We're going to look at, all right, the 150 strike. I like that strike. There we go. Got an 80 delta call. So inside I'll get back to the questions, by the way. Thank you so much for that great question. It allowed me to get everything back up and running. The 150 strike call option is 23 points, well, 24 points approximately in the money. Well, exactly 24 points. Good job, Boeing. It moved right while we were talking about it. 174. So we're 24 points in the money. We're deep in the money. We're going to have to pay for this option contract. But if we bought 100 shares, you're talking about $17,400 to buy that 100 shares. Now, we're going to use this as a stock substitute. By going deeper in the money, you're looking at getting something that acts a lot like the stock. And how do we know that? We look at the delta. The delta tells us if the stock goes up 1 point, how many cents our option contract should go up on just a pure quote basis. And it should go up about 80 cents. Now, another way to say it, there's many different ways to define delta, but you're getting about 80% of the stock price movement, right? If stock goes up 1, you'd make $100. Option goes up 1 and it moves 80 cents, you would make $80. So you're getting about 80% of that movement, 80% of that profit, if you're correct on your forecast. Now, that also means that if the stock goes down 1, you're going to lose 80 cents. And and this is in hypothetical because these are just theoretical numbers, but it gives you a realistic expectation as to how your option might move relative to the stock. So you got to pay for this because you're going to get that type of movement. You're going to get a lot of stock price representation. You're going to have to pay. So still a lot cheaper than buying the stock outright, but right now the ask price is $30.40. So you're talking about $3,040 to buy one contract plus commission. That would be your total risk. As opposed to $17,400, you're only risking $3,000 on this trade. This is one way to say, well, the market's up today, up 1%. I don't have the chart up now, but the chart has been fairly strong in Boeing. It's done better than most stocks in this time of year. A little bit to do with the defensive component of it. And with that mentioned, one of the downsides of doing this as an alternative to the stock is that you have wider bid-ask spreads. That's the biggest alternative to doing this type of strategy. Boeing is fairly liquid, and these markets aren't bad. You look at the stock, though, we have a 10-cent wide spread right now. That's pretty wide. Now 6 cents, okay. on the underlying stock. But on the option contract, we're looking at 20 cents. That's not bad for a leap option or a longer term option, deep in the money. And let's just be blunt about it. If we had tighter markets in these 80 delta options that go out 80 days in time, this strategy would be the most popular strategy probably in investing. You're going to buy something that you get a lot of stock price representation. You do have an expiration date, but you can put that out further in time, and you have limited and known risk. You know that Boeing went all the way down, almost hit 100. I'd much rather have this type of risk, $3,000, than $17,400, right? The bottom in Boeing was right around 100 before we got a little bit of a bounce up, and from that point, we're actually up quite a bit, 173. So almost, what is that, 80% since that bottom? So with that mentioned, this is an interesting alternative. You got some money on the sidelines. You feel like this might be a sector that you want to invest in. Here's one way to do it without all the risk of owning the stock. You got to deal with the bid-ask spread, got to work it a little bit. We do have 490 contracts in open interest, not a ton of volume today. Only 2 contracts have traded. Part of the reason why the bid-ask spread is a little bit wider, and that's part of the problem with it. But if we buy this will be our official paper trade for the week. Let's put that in the right rail, and I'll read it back to you. So here's our official paper trade for the week. We're buying to open one contract of the February 17th, 2023 expiration, 150 strike call at a limit price of, we'll go 330. Let's go 3030. That's just fun to say. It says it's on paper anyways. So we're going to try to work it in the middle a little bit. We're going to go for $30.30. It's a lot harder to do on one single option as opposed to doing that spread outright. But we put that order in. If we do fill this trade, that will be our maximum risk, $3,030 plus commission. If we buy one contract, because we're considering buying 100 shares of Boeing, and this would be our alternative, we're limiting our risk on the downside, giving us still some solid upside. We have 80 days remaining until that expiration date. Now, if I'm doing this trade, I'm going to give you my out because we always do a plan, and I know I'm going really long here. But with that said, if the market comes down to 150, I want to think about getting out of the trade. And I'm going to show you a real quick trick on the pricing. If I did this trade, and right now 174, well, an at-the-money option contract would be 175. So like we woke up tomorrow, stock went down 24 points to 150. Well, that would be an at-the-money option contract, right? Stock's at 150. The 150 strike would be the most at the money. Right now, an at the money option contract is trading for 1380 by 14. Lose half that value. If that happened right now, I would just get out. I would get out of the trade, lose about half the value, and move on. So on the downside, even though the stock would, in that scenario, the stock would have went down 24 points, you still don't have the same type of risk. And it has a lot to do with the dynamics of the options price. You're not down 24 points on your option trade. But on the upside, if it goes up, you pick up delta. You get more acceleration in your option contract. So another interesting dynamic of this, and once again, if we had tighter markets in these option contracts, it would be a very interesting alternative to owning the stock outright. All right, I'm sure I got a lot of questions. I'll try to answer as many as I can. Getting booted out of my account for some reason. Let me get to the answer. Here we go. Over here. Okay, questions. Is CCJ a buy? Don't really comment on individual stocks. I don't really know the background, don't know the portfolio, and that's not really what the show is about. The show is about learning option strategies that kind of match a marketplace. So we pick a random stock, nothing really meant to be a buy, and it's just that straightforward. That's not what Ally Invest about. It's about retail investors choosing for themselves. So take what you learn on the show and apply it to whatever underlying you want to apply it to. And I see Mohammed back. I haven't seen Mohammed in a little bit. Does Ally offer paper trading? No, we don't. So if you're trading on paper, we don't have that, and I don't foresee it coming. And I'll be blunt about it. But if anything, just look at the fills, talk about the trades, think about when you would get out of that trade and how you might adjust it. We try to get good dynamics behind all the trades that we do, talk about an exit plan, talk about an alternative strategy. We'll do that quite often. Hey, Brian, so much uncertainty still in the market. Why do you think the VIX is down to 22? Well, yeah, and is it because SPX and NDX are up? And that is true. One of the biggest things about the VIX that has happened is we got rid of a lot of big unknowns. We had the election, CPI data came out, and CPI was fairly good, and we saw a decline. And it was more about the direction, not the amount of the decline. But a lot of people are hoping that inflation has peaked. Housing market, a lot of housing prices are finally coming down. It's taken a while for that to show up in the CPI data. So because of those biggest unknowns, I think is why we see the VIX down low. I still think 22 is quite a bit low, though, considering the geopolitical concerns that are going on. And then we have Charles. Would a bear put spread be another way to make back some of the premium loss? Okay, so you sold. So this is in reference to the SMH trade, I'm assuming, Charles. And so we did go out and buy a long call spread. You could go and go below the market and sell a bear put spread. But now the market has gone down. We hit the 200-day moving average. We bounced off it, provided resistance. We're hoping for a breakout. That would have been a breakout moment. We could have had a couple of days above the 200-day moving average. That would have been good for the market. So now I am going in and adding more risk into the trade by doing the bear put spread and trying to say, oh my gosh, the market is still wrong, or this market still has it wrong and I'm still right. I don't like that trade as much, Charles, mainly because I'm adding more risk. And if I sell the short call spread and roll into the long butterfly, there's no more risk on the trade. I'm bringing in a little bit lesser credit. Like I said, I probably would have did that trade last week when I could have maybe brought in $1.50 in credit or so on the short call spread. But I'd much rather make an adjustment where I don't add risk. And this is what going from a long call spread to a long butterfly call spread for that's what it does, just in general. Okay, rail strike looming. Yeah, Matt is saying the rail strike is looming. I don't know if the marketplace is really reacting to that yet. I think that could be a little bit of the chop in the marketplace. It doesn't really, we haven't had, I think the VIX would be higher if they were more worried about the rail strike, because it is a big, very important situation. They're also talking about government maybe stepping in to try to do something about that, try not to let that happen. Who knows? It's going to get uglier before it gets better. All right. Yeah, no problem, Charles. Thank you for your question, and thank you for hanging out. Oh, man, long day, long-winded. Great show, though. Once again, sometimes if you are incorrect on your forecast, it gives you more opportunity to talk about the adjustment and about option trading in general. My name is Brian Overby, Senior Options Analyst at Ally Invest. If you like this video, please smash a thumbs up. Please click subscribe and ring the bell, and we'll see you on the next Stock Play of the Day. Thanks for coming, everyone.